Happy New Year to you and yours from the team here at Heritage Wealth Management. Some of us want to say good riddance to 2022 as it was a challenging year, but Laura and I have mixed emotions about that. We had our first grandchild born in November. The Wednesday before Christmas, we had a grandson born, so that made Thanksgiving a really special event for our families. So I have mixed emotions as I say good riddance, but from an economic standpoint, yes, good riddance. But I want to take a minute, though, and just talk about 22. If we go back to this time last year, remember, we were really in just the reopening phase from COVID. You know, how quickly we forget, but this year's been all about the reopening, and from Americans shopping in their home, on Amazon, buying goods, but now we're out doing things. We're out, going to restaurants again, going to movies. I don't know if you had a chance to travel over the holidays, but air travel is almost back to the level it was at pre-COVID. So I think what we will continue to see as we move into 23 now is a continuation of that. Retail sales have been trending down as people are spending more on services and experiences. And I think we'll see that trend continue, and that will be a good thing for the economy. Because as we look back at last year, probably the biggest major economic event would be the Fed changing its stance and beginning to raise interest rates. And that spooked both stock and bond investors, as for the first time since 2008, both stocks and bonds went down in the same year. And as the Fed very aggressively raised interest rates, actually in a very historical mean, we haven't seen them raise rates this fast, this much, really during our lifetime. But the reason they've done it is because of inflation. And last year the Fed was saying they thought inflation was just temporary, that it would work its way through the system. This year they acknowledged that it wasn't, and it was becoming a problem. And they've very aggressively gone after that, and they seem committed to winning this fight. And the reason this is so important is inflation is a cancer on the society, and it affects the lowest income people the most. So we have to win this battle, and I think the Fed at this point is committed. And what we've seen since June, which was the peak of inflation, is we've seen this trend going down. And actually, month over month, the numbers continue to get better. So let's hope that trend continues and that the Fed will be able to pause and hold steady and not have to raise interest rates anymore. The one thing that's done, though, is we are now getting paid to hold savings, where for most of the century, we have been essentially encouraging people to take on debt because the cost of capital has been almost free. So now we're back again to where we can actually get paid for holding savings. In our bond investments, last year was a terrible year for bonds, but going forward, we should be set up for better bond returns for the next several years. Back in that 5 to 6% rate of returns for that safer part of our portfolio. So there are some good things that have come out of this. Now with the equity markets, I would expect as we go into this first quarter, maybe even the first half of this year, to experience more volatility as the conversation is around the Fed and the recession talk. And those are just unknowable. What the Fed will do, whether or not we're going to go into recession, but these are all just temporary things when we look at it from a longer term perspective. We have to go back to our plan. We plan for events like this. They're no fun as we go through them, but we know that we're going to experience them. And I go back to just, what is the topic on television? We've got all the talking heads now talking about recession, talking Fed talk. That's really meaningless to a longer term investor, especially when we've got your plan in place and as we live out your plan, because those are unknowable. We don't know what's going to happen. We can't predict these things. One of the things that was such a big surprise last year is with everything that went on in Europe, the European equity markets outperformed the US equity market last year. Who could have ever imagined such a thing? But that goes back to why we have a globally diversified portfolio. Now China is reopening, whether they want to or not, but we're beginning to see emerging stocks, emerging markets companies really begin to do better in anticipation of basically 3 years of pent-up demand by the 1.4 billion people of China. So we just can't know for certain what's going to happen in the next 3, 6, 9 months, but we know that over time equities will grow with the markets, they'll grow with the economy, and we just have to be patient. as we live out your plan. So as we look into the future, and I'll try to wrap it up with this, I want to talk about this a little more in the future, but it's this reshoring. Going back to the fall of 2019, the beginning of COVID in China and the disruption of our supply chains, we're going to see this massive reshoring, which is manufacturing coming back to North America, Mexico, the United States. That will mean job, that will mean capital investments here in the United States instead of elsewhere in the world. So there's lots of things to be optimistic about as we look beyond this Fed interest rate raising cycle if we're just patient. Now, in the written market perspectives, I just did a quick snippet sort of in the middle of that. If you haven't read it, it's just, what is our philosophy? If you want to go back and read that real quick, I won't touch on it here. But just in parting, I want to say, as we watch the news media and we get bombarded with all this negative news, remember, we do not invest in the macro economy. We invest in a basket of companies. Sure, they're stocks, but the actual companies, and every day the employees of those companies go to work to cut costs, to grow productivity, to come up with new innovations, and that's what we invest in. And we can't forget that as we watch all this negative news. So having said all that, thank you for your time today, and we look forward to talking with you the first part of this year about your economy. So Happy New Year to you and your family.